Welcome to this comprehensive guide on passing the life insurance exam. Whether you're just beginning your journey into the insurance industry or looking for a structured way to study, this masterclass will give you everything you need to succeed. Over the next few hours, we'll break down every critical topic, explain complex concepts in simple terms, and provide real-world examples to help reinforce your understanding. By the end of this course, you'll not only be prepared to pass the exam, but you'll also have a solid foundation to start your career in the life insurance industry. Let's start with an overview of the exam itself. The life insurance exam is designed to test your knowledge of fundamental insurance concepts, policy structures, laws, and ethical practices. The purpose of the exam is to ensure that all licensed agents understand the principles of life insurance, the responsibilities of an insurance professional, and the laws that protect consumers. This exam is required for anyone looking to become a licensed life insurance agent. Whether you plan to sell policies independently, work for an agency, or offer life insurance as part of a broader financial services career, passing this exam is your first step. While the exact format of the test varies by state, most life insurance exams follow a similar structure. You can expect multiple-choice questions that cover topics such as types of life insurance policies, policy provisions and riders, underwriting processes, state and federal regulations, taxation, and ethical considerations. The test is usually taken at a designated testing center or online through an approved provider, and you'll need to achieve a minimum passing score, typically around 70%, depending on your state, so be sure to check. Now, let's talk about how to prepare effectively. The best way to approach this exam is with a structured study plan. Break your studying into sections and focus on one topic at a time. Use a combination of study materials, including textbooks, flashcards, practice exams, and audio lessons. It's essential to not just memorize facts, but to truly understand the concepts. This will help you apply your knowledge to real-world scenarios, which is critical since the exam often includes situational questions that test your ability to think like an insurance professional. One of the biggest mistakes people make when preparing for this exam is underestimating the complexity of the material. Many assume that because life insurance is just one type of financial product, the test will be straightforward. However, the exam covers a wide range of topics, including contract law, tax regulations, and risk management. Another common mistake is cramming at the last minute. Life insurance concepts build on each other, so it's important to pace yourself and review regularly. Taking full-length practice exams under timed conditions can also be a game-changer. It will not only help you get comfortable with the format, but also highlight areas where you need more review. Finally, be aware of tricky wording in exam questions. Many questions are designed to test your attention to detail, so always read carefully and watch out for qualifiers like always, never, and except. If you don't know an answer, use logic to eliminate incorrect choices. Sometimes, understanding what isn't correct can lead you to the right answer. With the right preparation, passing this exam is completely achievable. Now, let's dive into the fundamentals of life insurance, starting with the basics of how insurance works. At its core, insurance is a financial tool that helps individuals and businesses manage risk. It provides a safety net that protects people from financial loss due to unexpected events. In the case of life insurance, it ensures that a person's loved ones are financially secure in the event of their passing. But how exactly does insurance work? The concept of insurance is based on the transfer of risk. When someone purchases a life insurance policy, they are shifting the financial burden of a potential loss, such as the loss of income due to death, to an insurance company. In exchange, the policyholder pays a premium, which is a set amount of money, either monthly, quarterly, or annually. If the insured person passes away while the policy is in force, the insurance company provides a death benefit to the designated beneficiary, helping to cover expenses like funeral costs, outstanding debts, or lost income. For an insurance company to offer coverage, certain conditions must be met. This is where the elements of insurable risk come into play. Not every type of risk is insurable. To qualify, a risk must be measurable, predictable, and financially significant. This is why life insurance is based on statistics and mathematical calculations. Insurance companies rely on something called the law of large numbers to determine the likelihood of a claim being paid. This principle states that the larger the group of insured individuals, the more predictable losses become. In other words, by insuring thousands or even millions of people, an insurance company can accurately estimate how many claims it will have to pay, allowing it to set fair and sustainable premium rates. Another fundamental concept in life insurance is insurable interest. This means that for someone to take out a life insurance policy on another person, they must have a financial stake in that person's life. For example, a spouse, a business partner, or a parent can take out a life insurance policy on someone because they would suffer a financial loss if that person passed away. Without insurable interest, the system would be open to fraud, such as people taking out policies on strangers purely for profit. To better understand life insurance, it's important to get familiar with some key terminology. First, we have the policyholder, which is the person or entity that owns the policy. This is not always the same as the insured person. Then, we have the insured, who is the person whose life is covered by the policy. If the insured passes away while the policy is active, the insurance company pays out a death benefit to the beneficiary, who is the person or organization designated to receive the payout. The face amount of the policy refers to the stated amount of coverage, which is typically the sum paid out upon the insured's death. Now, let's take a moment to understand how life insurance helps create financial security. Life insurance is more than just a product. It's a long-term financial planning tool. For families, it provides income replacement, ensuring that dependents can continue their standard of living even after a wage earner passes away. For businesses, life insurance can protect key employees, fund buy-sell agreements, and ensure continuity in case of an unexpected loss. And for individuals, policies with cash value components can serve as a financial asset, providing liquidity, tax advantages, and even borrowing opportunities. Ultimately, life insurance is about protecting what matters most. It's a way for people to ensure that their loved ones are taken care of, and that financial obligations don't become a burden during difficult times. Now that we've covered the basics, we'll move on to the different types of life insurance policies and how they work. Now that we've covered the fundamentals of life insurance, it's time to dive into the different types of policies available. This is one of the most critical areas to understand for the exam because each type of life insurance serves a different purpose, meets different financial needs, and comes with its own unique structure. By the end of this chapter, you'll have a solid understanding of which policies provide temporary versus permanent coverage, how cash value works, and when a particular type of policy might be the best fit for a client. Another type of permanent coverage that offers more flexibility is universal life insurance. Unlike whole life, which has fixed premiums and guaranteed cash value growth, universal life gives the policyholder the ability to adjust their premiums and death benefit over time. This is made possible because universal life policies separate the cost of insurance from the cash value. The policyholder can choose to pay more into the cash value or, if times get tough, use the accumulated funds to cover premiums. There are different variations of universal life insurance as well. A traditional universal life policy earns a set interest rate on the cash value, similar to a savings account. A more modern option is Indexed Universal Life, IUL, where the cash value is tied to the performance of a stock market index, such as the S&P 500. This means there's the potential for higher returns, but also more risk. Another variation is Guaranteed Universal Life, GUL, which strips away most of the cash value component in exchange for lower, predictable premiums and a guaranteed death benefit. GUL is often chosen by clients who want permanent coverage without the investment risk of traditional universal life. Taking investment risk one step further, there's variable life insurance, which allows policyholders to invest the cash value in mutual fund-like sub-accounts. This means the cash value can grow significantly if the market performs well, but it also comes with the risk of losing value if the market declines. Because of this investment component, variable life insurance is classified as a securities product and requires both an insurance license and a securities license to sell. Beyond these major categories, there are a few specialty life insurance policies worth noting. Survivorship life insurance, also known as second-to-die insurance, covers two people under one policy and only pays out after both insured individuals have passed away. This is commonly used for estate planning, as it helps cover estate taxes or leave an inheritance for beneficiaries. There's also joint life insurance, which is similar but pays out after the first death, making it a popular option for married couples. For those looking for smaller policies specifically designed to cover funeral and burial costs, final expense insurance, sometimes called pre-need insurance, provides a low face amount, typically between $5,000 and $25,000, to help ease the financial burden of end-of-life expenses. Additionally, credit life insurance is a type of policy tied to a loan, ensuring that if the borrower passes away, the outstanding debt is paid off. Understanding all of these different policy types is essential for passing the life insurance exam and, more importantly, for guiding future clients toward the best policy for their specific needs. As we move forward, we'll take a closer look at policy provisions, riders, and options, some of the finer details that will help you fully understand how life insurance policies function in different situations. To make things simple, let's start with the most basic type of life insurance, term life insurance. Term life is exactly what it sounds like. Coverage that lasts for a specific term or period of time, such as 10, 20, or 30 years. If the insured passes away during that time, the policy pays out a death benefit to their beneficiary. If they outlive the term, the coverage simply expires, and there is no payout. Because it offers pure death benefit protection with no savings or investment component, term insurance is usually the most affordable option, making it ideal for young families, individuals with mortgages, or anyone looking for high coverage at a low cost. Now, within term life insurance, there are a few variations. One of the most common is level term insurance, where both the death benefit and the premiums remain the same throughout the policy's duration. For example, let's say a 35-year-old buys a 20-year, $500,000 level term policy. If they pass away at any point in those 20 years, their beneficiaries will receive the full $500,000. However, once those 20 years are up, the policy simply expires unless renewed or converted. Another type is decreasing term insurance, which works a little differently. Here, the death benefit decreases over time, typically in line with a debt like a mortgage. This type of policy is often used as mortgage protection since, as the homeowner pays down their loan, the amount of life insurance coverage decreases proportionally. Since the payout shrinks over time, these policies tend to have lower premiums than level term. On the other end of the spectrum, there's increasing term insurance, where the death benefit actually grows over time. This type of policy is less common, but it can be useful in cases where a client anticipates their financial responsibilities increasing in the future. The idea here is that inflation and future financial obligations, such as sending children to college, may require more coverage down the line, so the benefit amount gradually rises. Beyond the different structures of term life insurance, there are two important features that may appear on the exam: renewability and convertibility. A renewable term policy allows the policyholder to extend their coverage at the end of the term without having to undergo a medical exam. This means that even if their health has declined, they can still get covered, though at a higher premium based on their current age. Meanwhile, a convertible term policy provides the option to switch from term coverage to a permanent policy, again, without proving insurability. This is particularly useful for someone who starts with an inexpensive term policy, but later decides they want lifelong coverage. Now, while term life is great for affordability and short-term needs, it has one major downside: it does not build cash value. That's where permanent life insurance comes into play. Unlike term policies, which eventually expire, permanent life insurance provides coverage for the insured's entire lifetime as long as the premiums are paid. These policies also include a cash value component, which grows over time and can be accessed while the policyholder is still alive. One of the most well-known types of permanent insurance is whole life insurance. This policy offers a fixed premium, a guaranteed death benefit, and a cash value that grows at a steady, guaranteed rate. Essentially, a portion of each premium goes into this savings component, and over time, it accumulates tax-deferred. The cash value can then be borrowed against or even withdrawn, making whole life insurance both a protection tool and a financial asset. Within whole life insurance, there are different ways to structure the payments. A traditional whole life policy requires level premiums for the life of the policy. A limited pay whole life policy, on the other hand, allows the policyholder to pay off the entire policy in a set number of years, such as 10 or 20, after which no further premiums are required. A single premium whole life policy takes this concept a step further by funding the entire policy with one large upfront payment. While single premium policies require a significant initial investment, they immediately build substantial cash value and can be a great option for estate planning. Now that you have a solid understanding of different types of life insurance policies, it's time to explore the specific provisions, options, and riders that can be added to a policy. This chapter is essential because life insurance isn't just about choosing between term and permanent coverage, it's also about understanding how policies function after they're issued. Every life insurance contract includes standard provisions that define the rights and responsibilities of both the insurer and the policyholder. In addition, there are optional benefits, known as riders, that can be added to customize a policy. These details will show up on the exam, and more importantly, they'll help you explain policy features to future clients with confidence. Let's start with policy provisions, which are the standard clauses included in every life insurance contract. These provisions establish the rules of the policy, outline the insurer's obligations, and protect both the policyholder and the company from misunderstandings. One of the most important provisions is the entire contract clause. This clause states that the policy itself, along with any attached application and riders, makes up the complete agreement between the insurer and the policyholder. Nothing outside of this written contract can be considered legally binding. This protects both parties by ensuring that only the official terms of the policy apply. No verbal agreements or unwritten promises. Another key provision is the incontestability clause. Life insurance companies want to ensure that applicants provide truthful information when applying for coverage. However, mistakes or misrepresentations can happen. The incontestability clause gives the insurer a specific time frame, usually 2 years, to investigate and deny a claim if fraud or misrepresentation is discovered. After this period, the insurer cannot contest the validity of the policy, even if they later find out that the applicant provided false information. This protects beneficiaries by ensuring that an insurer cannot deny a claim indefinitely. The grace period provision is another important feature. It provides the policyholder with extra time, typically 30 or 31 days, to make a premium payment after it is due. If a policyholder forgets to pay on time, this provision ensures that their coverage isn't immediately canceled. If the insured passes away during the grace period, the death benefit will still be paid out, minus the overdue premium. Similarly, the reinstatement provision allows a lapsed policy to be restored under certain conditions. If a policyholder's coverage lapses due to non-payment, most insurers allow reinstatement within a certain time frame, typically 3 to 5 years, as long as the policyholder pays back the missed premiums and provides proof of insurability. Reinstating a lapsed policy is often more affordable than purchasing a new one, especially if the insured's health has declined. Another critical provision is the misstatement of age or gender clause. Life insurance premiums are calculated based on an applicant's age and gender, so any misrepresentation in these areas can affect pricing. If an insurer discovers that an applicant's age or gender was misstated, they won't cancel the policy. Instead, they will adjust the death benefit to reflect what the correct premium would have purchased. For example, if a policyholder claimed to be younger than they actually were, the insurer would reduce the payout to match the amount of coverage their premiums should have bought. Next, let's talk about policy options, which allow policyholders and beneficiaries to decide how certain aspects of the policy are handled. One of the most important is the settlement option, which determines how the death benefit is paid out when the insured passes away. The most straightforward option is the lump sum payout, where the beneficiary receives the entire death benefit in a single tax-free payment. This is the most commonly chosen option because it provides immediate access to funds. However, some beneficiaries may prefer a structured payout instead. For those who want the insurer to manage the funds, there's the interest-only option. In this case, the insurance company holds the death benefit and pays the beneficiary only the interest it earns. This can be useful when a beneficiary doesn't need the full amount right away, but wants a steady stream of income. Another alternative is the fixed period option, where the death benefit is paid out over a specific time frame, such as 10 or 20 years. If the beneficiary passes away before the full amount is distributed, the remaining payments go to a secondary beneficiary. Similarly, the fixed amount option allows the beneficiary to receive payments in a fixed dollar amount until the benefit is exhausted. For beneficiaries who want guaranteed lifetime income, there's the life income option, which functions like an annuity. The insurer calculates payments based on the beneficiary's life expectancy and guarantees payments for as long as they live. However, if the beneficiary passes away early, the remaining balance is typically kept by the insurer unless a life income with period certain option is chosen, which guarantees payments for a minimum number of years. Now, let's move on to policy riders, which are optional benefits that can be added to a policy for extra protection. Riders allow policyholders to customize their coverage based on their specific needs. One of the most common riders is the waiver of premium rider, which ensures that if the insured becomes totally disabled, they won't have to pay premiums to keep their coverage in force. This rider is particularly valuable because a disability could make it difficult for the policyholder to earn income, and without it, they might struggle to keep their life insurance active. Another popular option is the accelerated death benefit rider, which allows the insured to access a portion of their death benefit if they are diagnosed with a terminal illness. This can help cover medical expenses hospice care, or other end-of-life costs. Typically, the insurer will pay out up to 50% to 75% of the death benefit in advance, reducing the amount that the beneficiary will receive after the insured passes away. For families with young children, the Child Term Rider provides coverage for the insured's children under the same policy. This rider is typically low cost and provides a small death benefit if a child were to pass away. Additionally, many child riders include a conversion feature, allowing the child to convert the coverage into a permanent policy without proving insurability once they reach adulthood. The Accidental Death and Dismemberment (AD&D) rider provides an additional payout if the insured dies in an accident or suffers a serious injury, such as the loss of a limb. Because accidental deaths are often sudden and unexpected, this rider provides extra financial protection in cases where the insured's death was not due to natural causes. Another useful rider is the Guaranteed Insurability rider, which allows the policyholder to purchase additional coverage at specified ages or life events, such as marriage or the birth of a child, without needing to provide evidence of insurability. This is particularly helpful for younger policyholders who expect their insurance needs to increase over time. Understanding these provisions, options, and riders is crucial for passing the life insurance exam and for advising clients in the real world. Every policy is different, and having the ability to explain how a contract functions, how payouts can be structured, and how additional benefits can be added will make you a more knowledgeable and trusted professional. In the next chapter, we'll take a closer look at underwriting and risk classification, the process insurers use to determine how much a policyholder will pay for their coverage. Now that we've covered the different types of life insurance policies and how they function, it's time to take a closer look at how insurance companies determine eligibility and pricing. This process is called underwriting, and it plays a crucial role in the industry. Underwriting is how insurers assess an applicant's risk level to determine how much they should pay for coverage, or if they qualify for coverage at all. Every applicant is unique, and insurers rely on a variety of factors to make these decisions, including health, lifestyle, and financial history. Understanding the underwriting process is essential for passing the life insurance exam because it directly impacts policy approvals, premiums, and risk classification. More importantly, if you're selling life insurance, you'll need to explain to clients why they receive certain rates and what factors influence their policy options. At its core, underwriting is all about risk assessment. Insurance companies are in the business of managing risk, so they need to determine the likelihood that an applicant will pass away while their policy is in force. The higher the risk, the higher the premium, or the greater the chance the insurer may decline coverage altogether. This is why applicants go through an evaluation process, which includes a medical review, financial assessment, and lifestyle analysis. Let's start with the most common method of underwriting: medical underwriting. This is the process where the insurer evaluates an applicant's health to determine their insurability. Most policies require applicants to complete a medical questionnaire, which asks about past and present health conditions, prescription medications, family medical history, and lifestyle habits. For larger policies or older applicants, insurers may also require a paramedical exam, which is a basic health checkup conducted by a licensed medical professional. This exam typically includes measurements of height and weight, a blood pressure check, and sometimes a blood and urine test to screen for conditions like diabetes, high cholesterol, or drug use. In some cases, insurers may also request additional medical records from the applicant's physician, known as an attending physician's statement, AEEPS. If there are concerns about a specific health condition, such as heart disease, cancer, or past surgeries, The APS provides more detailed information that helps the insurer make a more informed decision. Another key component of underwriting is the Medical Information Bureau (MIB) report. The MIB is a database that insurers use to share and access information about past insurance applications. If an applicant has applied for life insurance before and was denied or rated at a higher premium, that information is recorded in the MIB. This helps insurers detect inconsistencies or undisclosed health issues that could indicate fraud or misrepresentation. Beyond medical history, insurers also look at an applicant's lifestyle choices. Certain habits and behaviors can significantly increase risk, leading to higher premiums or even policy denials. For example, smokers typically pay much higher premiums than non-smokers because smoking is linked to serious health risks like lung disease and heart failure. Similarly, heavy alcohol use, drug use, or a history of risky hobbies such as skydiving, scuba diving, or racing can lead to increased rates. Another factor that plays a role in underwriting is occupation. Some jobs come with a higher level of risk than others. For instance, construction workers, firefighters, police officers, and pilots are considered higher-risk applicants because of the dangerous nature of their work. On the other hand, an office worker or a teacher would likely receive more favorable rates because their job poses minimal physical risk. Financial underwriting is another important aspect of the process, especially for large policies. Insurers need to ensure that the amount of coverage applied for is reasonable based on the applicant's income, assets, and financial situation. This prevents overinsurance, where someone takes out an excessive amount of coverage that might create an incentive for fraud. Typically, insurers have income replacement guidelines, meaning they will approve coverage up to a certain multiple of an applicant's annual income, often 10 to 20 times their salary. For business owners, financial underwriting may also include reviewing company financials, tax returns, or business valuation reports. Once all of this information is gathered, the insurer classifies the applicant into a risk category, which determines the premium they will pay. There are 4 main risk classifications used in life insurance underwriting. At the top is the Preferred Plus, or Super Preferred category, which is reserved for applicants in excellent health, with no significant medical history, ideal weight, and no risky lifestyle habits. These individuals qualify for the lowest premiums available. Next is the Preferred category, which is for individuals who are in very good health but may have minor risk factors, such as slightly elevated cholesterol or a family history of illness. They still receive low rates, but not as low as Preferred Plus. The next tier is the Standard category, which is for applicants in average health with no major medical conditions, but may have a few risk factors, such as slightly high blood pressure or being overweight. This category represents the most common risk classification. For those with higher health risks, there is the Substandard category, sometimes referred to as rated policies. These applicants may have a history of chronic illness, obesity, or other medical concerns that increase their risk. Instead of being declined, they may still receive coverage, but at a significantly higher premium. For applicants who pose an extreme risk, such as those with terminal illnesses or severe medical conditions, coverage may be declined altogether. However, in some cases, these individuals may still qualify for guaranteed issue policies, which do not require medical underwriting but come with higher premiums and lower death benefits. Apart from traditional underwriting, some policies use a simplified or accelerated underwriting process. Simplified issue life insurance allows applicants to qualify for coverage by answering a short health questionnaire, with no medical exam required. While approval is faster, premiums are typically higher because the insurer takes on more risk without a full medical evaluation. An even more lenient option is guaranteed issue life insurance, which provides coverage with no health questions or medical exams. These policies are often marketed to seniors or individuals with serious health conditions who might not qualify for traditional coverage. However, they usually come with graded benefits, meaning the full death benefit is not available until after a waiting period, typically 2 to 3 years. If the insured passes away before this period, the policy only pays out the premiums paid plus interest. Technology has also brought about accelerated underwriting, which allows insurers to approve policies much faster by using big data and predictive analytics instead of requiring medical exams. By analyzing electronic health records, prescription databases, and other digital information, insurers can approve applicants within minutes instead of weeks. This method is becoming increasingly popular, especially for younger, healthy applicants looking for quick coverage. Understanding the underwriting process and risk classification is critical for passing the life insurance exam. It's one of the most complex but essential topics in the industry because it directly impacts how policies are priced and issued. Now that you have a clear understanding of how insurers assess risk, we'll move on to another important topic: the different types of beneficiaries, settlement options, and how life insurance benefits are paid out. Now that we've covered how life insurance policies are underwritten and issued, it's time to focus on what happens after the insured passes away. Specifically, who receives the death benefit and how it is paid out. This chapter is all about beneficiaries and settlement options, two critical components of every life insurance policy. Understanding these concepts is essential, not just for passing the exam, but for ensuring that clients' policies fulfill their intended purpose, providing financial security to their loved ones. Let's start with the beneficiary, which is the person or entity designated to receive the life insurance payout when the insured dies. The policy owner, the person who controls the policy, chooses one or more beneficiaries, and this designation determines who gets the money. Beneficiaries can be classified in a few different ways, so it's important to understand the distinctions. First, there are primary and contingent beneficiaries. The primary beneficiary is the first in line to receive the death benefit. If the primary beneficiary is alive when the insured passes away, they receive the full payout. However, if the primary beneficiary has already passed away, the benefit goes to the contingent beneficiary, also known as the secondary beneficiary. This ensures that if the primary beneficiary predeceases the insured, the money doesn't go into the insured's estate, which could lead to delays and probate issues. Beneficiaries can also be revocable or irrevocable. A revocable beneficiary can be changed at any time by the policy owner without needing permission. This offers flexibility in case the policy owner wants to adjust their plans due to life changes such as marriage, divorce, or the birth of a child. On the other hand, an irrevocable beneficiary cannot be changed without their consent. Once someone is named an irrevocable beneficiary, they have a legally protected interest in the policy, meaning the policy owner cannot remove them or make changes that would affect their share of the benefit without their approval. This is often used in legal agreements, such as divorce settlements or business partnerships. Another important concept is per capita versus per stirpes distribution. These terms come into play when there are multiple beneficiaries and one of them passes away before the insured. With a per capita designation, the death benefit is divided equally among the surviving beneficiaries. For example, if a father names his 3 children as beneficiaries and one of them passes away before he does, the remaining 2 children would each receive half of the benefit instead of the deceased child's share passing to their own heirs. With a per stirpes designation, however, the deceased beneficiary's share would go to their own children. Using the same example, if one of the father's children had passed away but had 2 children of their own, those two grandchildren would receive their parents' share of the payout, instead of the surviving siblings getting a larger portion. This method ensures that the insured's lineage continues to benefit from the policy. Now, let's talk about estate and trust beneficiaries. While most people name individual beneficiaries, some policy owners designate their estate as the beneficiary. This means that when the insured dies, the death benefit is paid to their estate and distributed according to their will. However, this is generally not recommended because it can cause delays in probate, expose the funds to estate taxes, and make them available to creditors. A better option for those who want structured control over the death benefit is to name a trust as the beneficiary. A trust is a legal arrangement that holds assets for designated beneficiaries and is managed by a trustee. This can be useful for parents who want to ensure their minor children receive the money in a controlled way, or for wealthy individuals looking to minimize estate taxes. For example, if a policy owner sets up a trust for their children, the trustee can distribute the money gradually, instead of giving them a lump sum all at once. Now that we've covered who can receive the death benefit, let's talk about settlement options, which determine how the payout is distributed to the beneficiary. While most people assume that life insurance is always paid as a lump sum, policy owners and beneficiaries have other options. The lump sum option is the most common because it provides the full death benefit immediately, tax-free. This allows beneficiaries to pay off debts, cover funeral expenses, or invest the money as they see fit. However, some beneficiaries, especially those who are not financially experienced, may prefer a structured payout instead. One alternative is the interest-only option. With this settlement option, the insurer holds on to the death benefit and pays the beneficiary only the interest that accrues on the funds. The principal amount remains untouched, and the beneficiary can choose to withdraw it at a later time. This is useful for individuals who don't need the full amount right away, but want to earn steady interest income. Another option is the fixed-period settlement, where the insurer distributes payments over a set period, such as 10, 20, or 30 years. The beneficiary receives equal payments during this time, and if they pass away before the full amount is distributed, the remaining funds go to a contingent beneficiary. This can help prevent the beneficiary from spending the money too quickly while ensuring financial stability over time. A similar option is the fixed-amount settlement, where the beneficiary chooses a specific dollar amount to receive each month or year until the benefit is exhausted. This allows for more flexibility in budgeting, but doesn't guarantee how long the payments will last, since it depends on the total benefit and the amount withdrawn. For those who want lifetime security, there's the life income option, which works like an annuity. The insurer calculates payments based on the beneficiary's age and guarantees payments for as long as they live. This prevents the risk of outliving the benefit, but it also means that if the beneficiary dies early, any remaining balance may be forfeited to the insurance company. To address this concern, there are life income with period-certain options, which ensure payments for a minimum number of years, even if the beneficiary dies early. Understanding beneficiary designations and settlement options is crucial for passing the life insurance exam. These choices affect how the death benefit is distributed and how efficiently it serves the insured's intentions. Now that we've covered this key topic, in the next chapter, we'll dive into policy loans, cash value accumulation, and non-forfeiture options, important features that come with many permanent life insurance policies. Now that we've covered how beneficiaries receive life insurance proceeds, it's time to dive into a crucial feature of permanent life insurance policies: cash value. This chapter focuses on policy loans, cash value accumulation, and non-forfeiture options, all of which play an essential role in how whole life, universal life, and variable life insurance policies function. Understanding these concepts is critical because they differentiate permanent policies from term insurance and impact how policyholders can access funds before death. Let's start with cash value, which is a living benefit that builds over time in permanent life insurance policies. Unlike term life insurance, which only provides a death benefit, permanent life policies have a savings component that accumulates tax-deferred growth. A portion of each premium payment goes toward maintaining the death benefit, while the rest is invested by the insurance company to build cash value. This cash value can be accessed by the policy owner in several ways, making permanent life insurance more than just a financial safety net for beneficiaries. The key ways to access this value are policy loans, withdrawals, and surrendering the policy. A policy loan is one of the most common methods policyholders use to access their cash value. Unlike a traditional bank loan, a policy loan does not require credit approval because the insurance company is essentially lending the policyholder their own money, using the cash value as collateral. This makes it a quick and easy source of funds, often used for emergencies, business investments, or even supplementing retirement income. However, policy loans come with some important rules and risks. First, the loan accrues interest, which the policyholder must pay back to avoid reducing the policy's value. If the loan is not repaid, the insurance company deducts the outstanding balance from the death benefit when the insured passes away. This means that if a policyholder borrows a significant amount and doesn't repay it, their beneficiaries might receive far less than expected. For example, imagine a policyholder with a $500,000 whole life policy and $100,000 in cash value. If they take out a $50,000 loan and don't repay it, the insurance company will deduct that amount, plus any accumulated interest, before paying the beneficiaries. If the total owed reaches the full cash value amount, the policy could lapse entirely. Policy owners also have the option to make withdrawals from the cash value. Unlike a loan, which must be repaid with interest, a withdrawal permanently reduces the death benefit. Withdrawals are typically only allowed up to the total amount of premiums paid, known as the cost basis, without triggering taxes. If a policyholder withdraws more than the cost basis, any excess amount is considered taxable income. For instance, if someone has paid $50,000 in premiums into their policy and their cash value has grown to $80,000, they can withdraw up to $50,000 tax-free. However, if they withdraw the full $80,000, the extra $30,000 is subject to income tax. Another way a policyholder can access cash value is by surrendering the policy. This means they voluntarily cancel the policy and receive the accumulated cash value, minus any surrender charges. This is often a last resort, since surrendering a policy means forfeiting the death benefit entirely. Speaking of surrendering a policy, this brings us to non-forfeiture options, which protect policyholders from losing all of their benefits if they stop paying premiums on a permanent life policy. These options allow policyholders to retain some form of coverage instead of letting the policy lapse completely. There are three main non-forfeiture options, and understanding them is essential for the life insurance exam. The first option is the cash surrender value. This allows the policyholder to surrender their policy in exchange for the accumulated cash value. However, there may be surrender charges, which are fees the insurer deducts for early termination, especially in the first few years of the policy. The longer a policy has been in force, the lower these charges typically become. The second option is reduced paid-up insurance. With this option, the policyholder stops making premium payments, but instead of canceling the policy, the insurer uses the existing cash value to purchase a smaller, fully paid-up policy. The new policy will have a lower death benefit, but will stay in force for the insured's lifetime without requiring additional premiums. For example, if a policyholder has a $250,000 whole life policy but can no longer afford the premiums, the insurer may convert the policy into a paid-up policy with a reduced death benefit of $100,000. The insured will still have lifetime coverage, but at a lower benefit amount. The third option is extended term insurance, which allows the policyholder to use their cash value to buy term insurance instead. This keeps the original death benefit intact, but only for a limited period. Once the term period expires, the policy terminates unless the policyholder renews or converts it. For example, if someone has a $500,000 whole life policy but can no longer afford the premiums, they could use their cash value to buy a term policy with the same $500,000 death benefit. However, this new term coverage might only last 10 or 15 years, depending on the amount of cash value available. Non-forfeiture options are important because they give policyholders flexibility when financial circumstances change. Instead of losing all the money they've put into their policy, these options allow them to retain some level of benefit. Understanding how policy loans, cash value, and non-forfeiture options work is essential because they impact how permanent life insurance functions as both a protection tool and a financial asset. These features allow policy owners to borrow against their policy, access funds in retirement, and adjust coverage based on changing financial needs. In the next chapter, we'll explore another critical topic: riders and policy provisions, which provide additional benefits and customization options to life insurance policies. These features can enhance coverage, offer protection against disability or critical illness, and even allow for premium waivers under specific conditions. Now that we've covered life insurance policies, let's shift gears and discuss another key financial tool: annuities. Annuities are often used as part of retirement planning, and understanding how they work is crucial not only for the life insurance exam, but also for advising clients on their long-term financial security. To start, let's break down what an annuity is. An annuity is a financial product that provides a steady stream of income, typically used to supplement retirement savings. The basic idea is simple. You make a lump sum payment or series of payments to an insurance company, and in return, the insurance company guarantees regular payments back to you for a certain period of time, or even for the rest of your life. Annuities come in various forms, but we'll focus on the most common types: fixed, variable, and indexed annuities. Each has its own features and benefits, so it's important to understand how they differ. First, let's talk about fixed annuities. A fixed annuity provides predictable, guaranteed payments over time. The insurance company invests the money you pay into the annuity and, in turn, provides you with a fixed rate of return, meaning you know exactly how much you'll receive each month. For example, if you invest $100,000 in a fixed annuity with a guaranteed 4% annual return, you'll know that your annuity will pay out a fixed amount based on that rate. Fixed annuities are typically less risky because they offer stability and security, which is why many people use them as a predictable income source during retirement. Next, we have variable annuities. With a variable annuity, your payments fluctuate based on the performance of the underlying investments, such as stocks or bonds. The key difference here is that, while there's the potential for higher returns, there's also more risk involved. If the market performs well, you could see larger payouts, but if the market drops, your payouts could decrease. For instance, if you invest in a variable annuity and the investments perform well, your monthly payments could be much higher than in a fixed annuity. However, if the market crashes, your payments could be lower or even less than your initial investment. This makes variable annuities a better fit for people who are willing to take on more risk in exchange for the possibility of greater returns. Then there's the indexed annuity, which combines elements of both fixed and variable annuities. An indexed annuity's returns are tied to the performance of a specific market index, like the S&P 500. While the returns are typically not as high as those of a variable annuity, indexed annuities offer a balance between risk and reward. If the market performs well, you'll receive higher payouts, but if the market doesn't do as well, your payments won't drop below a minimum guaranteed amount. This means you have some upside potential, but also a safety net if the market underperforms. Now that we understand the main types of annuities, let's talk about the two key phases of an annuity: the accumulation phase and the payout phase. During the accumulation phase, you're making payments into the annuity, either as a lump sum or through periodic contributions. This is the period where your funds grow, either through a fixed interest rate, variable investments, or an index. The longer you contribute to the annuity, the more it will grow, and the larger your eventual payout will be. Once you reach the payout phase, the insurance company begins making regular payments to you. These payments can last for a specific period, like 10 or 20 years, or for the rest of your life, depending on the terms of your contract. The payout phase is what most people are focused on when they invest in an annuity, as it provides a guaranteed stream of income during retirement. An important consideration with annuities is taxation. The money you invest in an annuity grows tax-deferred, meaning you don't pay taxes on the earnings until you begin receiving payments. However, when you do start getting paid, your annuity payments are subject to income tax. This is an important factor to keep in mind when planning your retirement, as it impacts the amount you'll actually receive after taxes. One more thing to note is annuity suitability. While annuities can be an excellent tool for some people, they're not right for everyone. They can be more expensive than other retirement savings options, and in some cases, the terms may be restrictive. Therefore, it's essential for agents to assess the needs and financial goals of their clients before recommending an annuity. For example, if someone is young and looking for growth potential, they may want to consider more aggressive investment options. On the other hand, if someone is nearing retirement and looking for guaranteed income, an annuity might be a perfect fit. Finally, we can't talk about annuities without addressing senior protections. Because annuities are commonly marketed to retirees, many states have specific regulations to protect seniors from misleading sales tactics or unsuitable product recommendations. These regulations include ensuring that agents fully disclose the terms and risks of annuities and evaluate whether the product is appropriate for the client's financial situation. Understanding annuities and their role in retirement planning is crucial because, for many clients, these products can provide a reliable income stream in their later years. Annuities are a unique tool in the financial landscape, and knowing the ins and outs of how they work will help you better serve your clients and help them make informed decisions about their future. In the next chapter, we'll explore federal and state regulations that govern life insurance products and agents. These regulations help ensure that both consumers and agents are protected, and understanding them is essential for passing your exam and succeeding in the field. In the world of insurance, it's not just about the policies themselves. There are also a variety of federal and state regulations that shape how the industry operates. As an insurance professional, understanding these regulations is essential not only for ensuring compliance, but also for providing the best service to your clients. This chapter will dive into the role of state insurance departments, the National Association of Insurance Commissioners, NAIC, licensing requirements, unfair trade practices, and much more. Let's start with the role of state insurance departments. Each state in the U.S. has its own insurance department that is responsible for regulating the insurance industry within that state. These departments oversee the licensing of insurance agents, monitor the financial stability of insurance companies, and enforce rules designed to protect consumers. For example, if a consumer has a complaint against an insurance company or agent, they can contact the state's insurance department, which can investigate and take action if necessary. The state insurance department ensures that both consumers and agents follow the rules, and they provide oversight to make sure everything is fair and transparent. At the national level, we have the National Association of Insurance Commissioners, NAIC. The NAIC is a collective organization made up of state insurance regulators. It works to promote uniformity and cooperation among the states to regulate insurance in a way that protects consumers while allowing the industry to thrive. The NAIC drafts model laws, which are guidelines that states can adopt to standardize insurance regulations across the country. While each state has the authority to make its own laws, many states choose to follow these model laws to ensure consistency. For example, the NAIC's Model Unfair Trade Practices Act provides guidelines to prevent insurance fraud, misrepresentation, and other deceptive practices. While individual states can tweak these regulations, many of them base their laws on NAIC's model standards to create a unified framework for the industry. Next, let's talk about licensing requirements. In order to sell insurance, agents must be licensed in the state where they plan to do business. Licensing requirements can vary by state, but generally, an agent must complete pre-licensing education, pass a state exam, and submit an application to the state's insurance department. Each state sets its own exam content, so agents must be familiar with the specific rules and regulations in the state they are licensed in. For example, if an agent is licensed in Illinois, they are required to understand Illinois' specific insurance laws and regulations. If they want to expand their business to another state, they will need to meet that state's licensing requirements. This may include taking an additional exam or completing continuing education courses. Once licensed, insurance agents also have ongoing responsibilities. Continuing education, CE, is required to keep a license active. States typically require agents to complete a certain number of hours of education every few years. These courses ensure that agents stay up to date on changes in laws, regulations, and best practices. Continuing education is a critical part of an agent's career because it ensures they remain knowledgeable and compliant with the law. Now let's move on to unfair trade practices. Insurance companies and agents must operate ethically and fairly, which is why there are strict rules in place to prevent unfair trade practices. These include misrepresentation, coercion, rebating, and false advertising. Misrepresentation refers to giving false or misleading information to a client. For example, if an agent tells a client that a particular policy offers benefits that it doesn't, that would be considered misrepresentation. Similarly, coercion is when an agent pressures a client into buying insurance, which violates ethical standards. Rebating is the illegal practice of offering a portion of the premium or commission to the insured as an incentive for buying a policy. If an agent offers money or gifts to a client as a way to influence their decision, that's a violation of unfair trade practices. Another major area of regulation is advertising and sales practices. The insurance industry is tightly regulated to ensure that advertisements and sales materials are truthful and not misleading. For example, if an insurer promotes a policy as having certain benefits, those benefits must be clearly stated and substantiated. Misleading advertisements can result in serious penalties, including the loss of an agent's license. Now, let's talk about privacy laws and consumer protection. Insurance agents handle sensitive personal and financial information, so it's important to understand privacy regulations. The Gramm-Leach-Bliley Act, GLBA, is a key federal law that protects consumer privacy in the financial services industry, including insurance. The GLBA requires insurance companies and agents to safeguard customers' personal and financial data. They must also give consumers the opportunity to opt out of having their information shared with non-affiliated third parties. Similarly, HIPAA, the Health Insurance Portability and Accountability Act, protects the privacy of individuals' health information. Since life insurance policies often require medical history information, agents must ensure that they follow HIPAA guidelines when handling sensitive medical data. Consumer protection laws also cover areas like ensuring that clients understand the policies they purchase and that they're not being taken advantage of. For example, the free look period in life insurance allows a policyholder to review a policy after purchase and cancel it without penalty if they change their mind. Agents are required to clearly explain this feature to their clients. Finally, let's touch on the topic of fiduciary duty. As an insurance agent, you have a fiduciary responsibility to act in the best interest of your clients. This means you must offer suitable products that meet their needs and ensure they fully understand the terms of the policies you recommend. A breach of fiduciary duty can result in legal consequences and damage to your reputation. Understanding federal and state regulations is critical to your success as an insurance professional. By complying with these regulations, you not only avoid legal issues, but also build trust with your clients, which is essential for long-term success. In the next chapter, we'll dive into taxation of life insurance and annuities, which will help you understand how these financial products are taxed and how they fit into your clients' broader financial plans. In this chapter, we're going to explore an important aspect of life insurance and annuities: taxation. These financial products are often used as both protection and a way to build wealth, and understanding how they are taxed is crucial for both you and your clients. This chapter will break down the tax treatment of life insurance proceeds, cash value growth, modified endowment contracts, AMECs, and annuities. By understanding these concepts, you'll be able to guide your clients through the tax implications of their life insurance policies and annuity contracts. Let's begin with life insurance proceeds. One of the key benefits of life insurance is that the death benefit paid to a beneficiary is generally income tax-free. This means that when a policyholder passes away, their beneficiaries don't have to pay income tax on the payout, no matter how large it is. For example, if someone has a $500,000 life insurance policy and their beneficiary receives that amount, they will not owe any income tax on that sum. However, it's important to note that estate taxes may still apply if the deceased person's estate exceeds the federal estate tax exemption amount. In that case, the life insurance proceeds may be included in the taxable estate, potentially subjecting the beneficiaries to estate taxes. This is something you should be aware of, especially when dealing with larger policies or estates. Now let's discuss the cash value growth of permanent life insurance policies. Unlike term life insurance, which provides only a death benefit, permanent policies such as whole life and universal life accumulate cash value over time. The great thing about this cash value is that it grows on a tax-deferred basis. This means that the policyholder does not have to pay taxes on the cash value growth as it accumulates, as long as the money remains in the policy. For example, if a policyholder's whole life policy has accumulated $50,000 in cash value, they won't have to pay taxes on that amount unless they take money out of the policy. The growth continues to compound without being taxed during the accumulation phase, which is a major advantage for policyholders looking to build wealth over time. However, when policyholders access the cash value by withdrawing or taking a loan, taxes may come into play. If a policyholder withdraws more than the amount they've paid in premiums, called the cost basis, the excess is considered taxable income. For example, if a policyholder has paid $30,000 in premiums and their policy's cash value has grown to $60,000, withdrawing more than $30,000 would result in taxable income on the difference. There's also the potential tax treatment, when a policyholder surrenders their life insurance policy for its cash value. If the total cash value is greater than the premiums paid, the excess is considered taxable income. For example, if someone surrenders a policy with $80,000 in cash value and they've paid $50,000 in premiums, the $30,000 difference would be taxable income. Now let's move on to modified endowment contracts, or MECs. A modified endowment contract is a type of life insurance policy that has become subject to different tax rules because it fails to meet certain IRS requirements regarding the premium-to-death benefit ratio. In simple terms, MECs are life insurance policies that are overfunded, meaning too much money is put into the policy too quickly. The main concern with MECs is that they lose some of the favorable tax treatment available to traditional life insurance policies. Specifically, withdrawals and loans from an MEC are subject to income tax and may incur a 10% penalty if the policyholder is under the age of 59 and a half. This makes MECs less attractive for those who are looking to use life insurance as a savings vehicle. However, if the policyholder is over 59 and a half, they can access the funds without the penalty, though the withdrawals or loans will still be taxed. To avoid turning a policy into a MEC, insurance companies must ensure that the premiums paid do not exceed certain limits, keeping the policy within the 7-pay test. This test ensures that the policy meets the IRS guidelines for life insurance tax advantages. As an agent, it's important to help your clients understand the risks of overfunding their policies and potentially creating an MEC. Now let's shift gears and talk about annuities. An annuity is a financial product that provides a series of payments made at regular intervals, usually after a lump sum payment or a series of premium payments. Annuities are often used for retirement income, but understanding their tax treatment is key for both you and your clients. Annuities grow on a tax-deferred basis, meaning that the money invested in the annuity is not taxed while it grows. For example, if someone invests $100,000 in a fixed annuity, they won't pay taxes on the earnings during the accumulation phase, which allows the money to grow faster than it would in a taxable account. However, when the policyholder begins receiving payments, those payments are taxed as ordinary income. The amount of tax depends on how much of the annuity's value was principal, the amount originally invested, versus earnings, the growth. For instance, if a policyholder invests $100,000 in an annuity and over time it grows to $120,000, the first $100,000 in payouts is considered a return of principal and is not taxable. However, the $20,000 in growth is taxable as ordinary income. There are a couple of different types of annuities, including fixed, variable, and indexed annuities, each with their own tax implications. Fixed annuities provide predictable, fixed payments, while variable and indexed annuities are tied to market performance and may offer greater growth potential. But they also come with more risk. The tax treatment, however, remains the same across these types of annuities: tax-deferred growth during accumulation and ordinary income tax during the payout phase. Lastly, let's briefly cover the 1035 exchange, which allows policyholders to exchange one life insurance policy or annuity for another without triggering a taxable event. The 1035 exchange rules allow for the deferral of taxes on gains when replacing an old policy with a new one, as long as the exchange is done correctly. This can be a great strategy for clients who want to upgrade their coverage or change their investment strategy without incurring taxes on the existing policy's growth. Understanding the tax implications of life insurance and annuities is essential for helping your clients make informed decisions about their financial futures. Whether it's guiding them to the right policy or helping them understand the best way to access their funds, you need to be aware of how taxes will affect their choices. In the next chapter, we'll look at group life insurance and how it fits into business settings. We'll also discuss employer-sponsored plans, key person insurance, and other ways that life insurance can be integrated into business planning. In this chapter, we'll discuss group life insurance and its role in business settings. Group life insurance is often offered by employers to their employees, and understanding how it works is essential for the life insurance exam. It's a type of insurance where a single policy covers a group of people, usually through an employer or an association, and the employer is the policyholder. In most cases, the employees are the insured parties, and the employer provides coverage as part of a benefits package. This kind of insurance is usually offered at a lower cost than individual life insurance because the risk is spread across a large pool of people. The premiums are often paid by the employer, though sometimes employees contribute to the cost, particularly for additional coverage beyond the basic plan. One of the key features of group life insurance is that it is usually offered without the need for medical underwriting. This means employees don't have to pass a health exam or answer any medical questions to get covered. As long as they meet the eligibility requirements, they are automatically enrolled in the policy. This makes it a valuable benefit for employees who may have difficulty getting individual life insurance because of pre-existing health conditions. Group life insurance is typically term insurance, meaning it provides coverage for a set period, often 1 year. It's usually renewable, and in some cases, employees may be able to convert their group policy into an individual policy if they leave the company, though they might face higher premiums or need to undergo medical underwriting. Another important aspect of group life insurance is that it can be either contributory or non-contributory. In a contributory plan, the employee pays part of the premium, and the employer covers the rest. Employees must opt into these plans, and their participation is voluntary, but they must sign up during an enrollment period to be covered. On the other hand, in a non-contributory plan, the employer covers the entire premium, and employees are automatically enrolled in the plan, so there's no cost to them. Non-contributory plans typically have higher participation rates because employees don't have to pay anything out of pocket. Group life insurance can provide a basic level of coverage, often equal to 1 or 2 times the employee's salary, and sometimes employees have the option to buy additional coverage. This is known as supplemental coverage, and while it adds extra protection, it's typically paid for by the employee. While group life insurance is a great benefit, there are some limitations. Most importantly, the coverage ends when the employee leaves the company, either through retirement or another reason. In some cases, the employee may be able to convert the group policy into an individual policy, but this could come with higher premiums and could require medical underwriting. Now let's move on to business uses of life insurance. Life insurance plays a crucial role in business planning, especially when it comes to things like key person insurance, buy-sell agreements, and executive benefits. One key business use of life insurance is for key person insurance. This is when a business takes out a life insurance policy on a key employee, someone whose loss would significantly impact the company. The business is both the policyholder and the beneficiary, and if the key person passes away, the death benefit helps the business cover the financial gap, such as hiring a replacement or compensating for lost revenue while the business adjusts. Another important business use is the buy-sell agreement. which is a contract that outlines what will happen to a business if one of the owners passes away, becomes disabled, or retires. These agreements are often funded with life insurance policies. The life insurance death benefits are used to buy out the deceased owner's share of the business. There are two common types of buy-sell agreements: the cross-purchase agreement and the entity purchase agreement. In a cross-purchase agreement, each owner buys life insurance on the others, and the death benefit is used to buy the deceased owner's share. In an entity purchase agreement, the business itself buys the life insurance policies on the owners, and the death benefit is used to buy back the deceased owner's share of the business. Life insurance can also be used as part of executive compensation packages. One strategy is the executive bonus plan, where a business provides an executive with a life insurance policy as a benefit. The business typically pays the premiums, and the executive owns the policy. This can be a valuable tool for attracting and retaining top talent, and it also has tax advantages for both the business and the executive. The business can often deduct the premiums as a business expense, while the executive is taxed on the value of the premiums as income. The executive, in turn, can use the policy for their own personal needs, such as borrowing against the cash value or naming their own beneficiaries. There's also a strategy known as split-dollar life insurance, where the employer and the employee share the costs and benefits of a life insurance policy. In this arrangement, the employer pays a portion of the premiums, while the employee covers the remainder. The employer typically receives a portion of the death benefit equal to the premiums they paid, and the rest goes to the employee's beneficiaries. This can be a useful tool for businesses to offer extra benefits to key employees while sharing the cost. When it comes to tax considerations, life insurance purchased for business purposes can have different tax treatment than individual life insurance policies. For instance, premiums paid by the business for key person insurance are usually not tax-deductible, but the death benefit is typically received tax-free. Similarly, life insurance used in buy-sell agreements may not be deductible by the business, but the death benefit is often paid out tax-free to the business or surviving owners. Understanding group life insurance and its various business uses is vital, both for passing your exam and for applying this knowledge in real-world scenarios. From protecting employees to safeguarding business continuity, life insurance offers flexibility and financial security in both personal and business settings. It's important to know the different types of coverage, the roles of the policyholder and beneficiaries, and the tax implications of each strategy. In the next chapter, we will look at Social Security and government programs, which will help you understand how life insurance fits within the broader framework of social safety nets and government support. In this chapter, we will discuss how life insurance interacts with Social Security and other government programs, which play a significant role in providing financial support to individuals and families. While life insurance serves as a private means of protection, government programs like Social Security, Medicare, and Medicaid provide important safety nets, often at no additional cost to individuals who qualify. Understanding these programs, as well as the life insurance-related aspects of them, is important for both your exam and a deeper understanding of financial protection systems. Let's start with Social Security. Social Security is primarily known for providing retirement benefits to individuals, but it also offers survivor benefits to the families of deceased workers. This means that if a wage earner passes away, their spouse, children, and sometimes even dependent parents may be eligible for a financial benefit from Social Security. The amount depends on the deceased worker's earnings history and the survivor's relationship to them. For example, a surviving spouse might receive a portion of the deceased spouse's Social Security benefit. Children under the age of 18, or up to 19 if they're still in high school, can also receive benefits. These benefits are not intended to replace a primary income, but they can help to cover some living expenses for the surviving family members. One important consideration for the life insurance exam is that Social Security survivor benefits are generally available only to people who have worked and paid into the Social Security system for a required amount of time, often referred to as quarters of coverage. If someone has worked for enough years and earned sufficient credits, their survivors can access this benefit, which is a critical point to remember for exam questions about Social Security eligibility. In addition to survivor benefits, Social Security also provides disability income protection for individuals who become disabled and are unable to work. This benefit is available to those who have worked long enough and earned sufficient credits, just like the survivor benefit. The disability benefits are based on the individual's previous earnings, and if someone becomes disabled before reaching retirement age, they can receive monthly benefits that replace part of their lost income. These benefits are not paid indefinitely. They are reviewed periodically, and recipients must meet specific criteria to remain eligible. Next, let's talk about Medicare and Medicaid, which are government programs that provide health coverage, particularly for older adults and low-income individuals. Medicare is a federal health insurance program available to people aged 65 and older, and to some younger individuals with disabilities. It has 4 parts: Part A, which covers hospital insurance; Part B, which covers medical insurance like doctor's visits; Part C, which is Medicare Advantage, offering additional coverage through private insurers; and Part D, which helps cover prescription drugs. Medicare is important because it offers basic health coverage for retirees, but it doesn't cover everything, which is where private insurance can play a role in filling the gaps. On the other hand, Medicaid is a joint federal and state program designed to help low-income individuals and families, regardless of age. Medicaid helps pay for medical services that are not covered by Medicare, especially for people who have limited financial resources. Each state runs its own Medicaid program, so coverage and eligibility requirements vary depending on where you live. This program is a vital part of providing health care for those who might otherwise struggle to afford medical treatment. For individuals and families, life insurance can complement these government benefits. For example, while Social Security provides some financial help in the event of a death, it often doesn't replace all lost income, which is why having life insurance can be crucial. Life insurance offers additional financial security, especially for families who might not be eligible for sufficient survivor benefits, or for individuals who want to ensure their loved ones are financially protected beyond what Social Security can offer. For instance, if a family's primary earner passes away, the survivor benefits from Social Security might not be enough to maintain their standard of living. In such a case, life insurance can fill the gap, helping the survivors cover things like mortgage payments, education costs, and daily living expenses. In addition to life insurance, some individuals may also use viatical and life settlements. These are special arrangements that allow policyholders with a terminal illness to sell their life insurance policy for a lump sum before they pass away. Viatical settlements are typically for individuals with a terminal diagnosis, while life settlements are available to those with other serious conditions. These settlements allow individuals to access the death benefit early, providing them with immediate financial relief. The buyer of the policy becomes the new beneficiary and will receive the death benefit when the original policyholder dies. Understanding how life insurance interacts with government programs is crucial, especially when considering how individuals can combine these resources to create a more comprehensive financial plan. Government programs like Social Security and Medicare provide essential support, but they often have limitations. Life insurance can help fill those gaps, offering additional financial protection when it's needed most. Knowing these details will not only help you pass the exam, but also deepen your understanding of how different forms of financial protection work together to support individuals and families. In the next chapter, we will look at the ethics and best practices for insurance agents, which is an essential part of understanding your responsibilities and how to best serve your clients with integrity and professionalism. In this chapter, we will explore the critical role of ethics and professionalism in the life insurance industry, especially for agents who represent insurance companies and interact with clients. As an agent, it's not just about selling policies, it's about building trust, maintaining integrity, and ensuring that clients' needs are met in a responsible and fair manner. Understanding the ethical responsibilities you hold as an insurance agent is not only essential for passing the exam, but also for becoming a successful and respected professional in the industry. The foundation of ethical behavior in insurance is rooted in fiduciary responsibility. As an agent, you are entrusted with managing your clients' financial well-being, which means you have a duty to act in their best interests at all times. This means providing honest, accurate, and complete information about the policies you are recommending. It's not enough to just make a sale. You need to ensure that your clients fully understand their options, including the benefits, risks, and costs associated with any policy they purchase. One of the most important ethical principles in the insurance industry is suitability. This means recommending products that meet the specific needs and financial situation of the client. For example, if a young family is looking for life insurance, they might be best served by a term policy that provides affordable coverage for a set period. On the other hand, a retired couple looking for lifelong coverage may be better suited to a whole life or universal life policy that builds cash value over time. Recommending a policy that is unsuitable for the client's needs, whether due to a mismatch in coverage, cost, or other factors, could not only harm the client but also lead to legal and regulatory consequences for you as the agent. Another critical aspect of ethical conduct is client confidentiality. As an insurance agent, you will have access to sensitive personal and financial information about your clients. You must safeguard this information and ensure it is not shared without the client's consent, except where required by law. This includes respecting privacy laws like the Gramm-Leach-Bliley Act, GLBA, which mandates that financial institutions, including insurance companies, protect customers' private financial information. A breach of confidentiality can lead to serious legal repercussions, harm your professional reputation, and destroy the trust you've worked to build with clients. While it's essential to uphold client confidentiality, it's also important to practice full disclosure. When recommending policies, you must provide clients with all relevant information, including any potential exclusions, limitations, or riders that may apply to the policy. If you fail to disclose important details, such as the possibility of premiums increasing or specific exclusions that may affect coverage, you could be accused of misrepresentation or even fraud. Transparency is key, and clients should be empowered to make fully informed decisions about their insurance needs. Next, let's talk about the replacement rules, which govern when and how life insurance policies can be replaced. Replacing a policy is a big decision for the policyholder, and it can have both positive and negative consequences. As an agent, you must ensure that any policy replacement is in the best interest of the client. For example, if a client is replacing an existing policy with a new one, you must thoroughly evaluate the costs and benefits, including any surrender charges, loss of accumulated cash value, and potential new contestability periods. You also need to provide the client with a written notice of replacement, ensuring they are fully informed about the implications of their decision. Churning and twisting are unethical practices that involve persuading clients to replace their policies unnecessarily or misrepresenting the benefits of new policies. These actions are prohibited by law and can lead to disciplinary action and loss of licensure. Ethical sales practices also extend to how you handle advertising and solicitation. It's important to avoid misleading or deceptive marketing tactics that could misrepresent a policy's coverage or benefits. If a potential client is misled by false advertising, it not only damages your credibility, but could result in regulatory penalties and lawsuits. Always make sure that any promotional material you use is clear, accurate, and aligned with the actual terms and conditions of the policies you're offering. It's also essential to never offer illegal inducements, such as promising gifts or cash rewards in exchange for purchasing a policy. Another aspect of best practices for agents involves maintaining continuing education. As the insurance industry evolves, it's essential to stay up to date with new products, changes in regulations, and the latest ethical guidelines. This is why continuing education is required by most states for insurance agents. Participating in these programs not only ensures you remain in compliance with licensing requirements, but also helps you stay informed about best practices and new developments in the field. Keeping up with industry changes is vital to maintaining your professionalism and providing the best service to your clients. In addition to continuing education, it's also important to adhere to your fiduciary duties and uphold the highest standards of professionalism in every interaction with clients, colleagues, and others in the industry. Being ethical means doing what's right, even when it's not easy, and always prioritizing the client's needs over personal gain. It involves acting with integrity, being honest about what you can and cannot offer, and ensuring that your advice is based on sound knowledge and experience. Building trust with your clients is a long-term process, but it's one of the most valuable assets an agent can have. In summary, ethics and best practices are fundamental to a successful career as an insurance agent. By acting with integrity, adhering to fiduciary duties, ensuring the suitability of the policies you recommend, and keeping client information confidential, you will not only pass your exam, but also build a strong, reputable practice. In the next chapter, we'll explore policy replacement in greater detail, focusing on the legal requirements and the considerations agents need to take into account when assisting clients with replacing their existing policies. In this chapter, we'll explore the concept of policy replacement and the special considerations that come into play when an insurance agent is involved in replacing an existing life insurance policy with a new one. Policy replacement is a process that should not be taken lightly, as it can have significant financial and coverage implications for the client. Understanding the rules and regulations governing replacement, as well as recognizing the factors that could make replacement necessary, is crucial for both passing the exam and ensuring that you act in the best interest of your clients. Let's begin by discussing why clients might consider replacing their life insurance policy in the first place. There are several reasons why someone might decide to replace their existing policy with a new one. One of the most common reasons is the desire for better coverage. As a person's life circumstances change, such as getting married, having children, or purchasing a home, they may find that their current policy no longer provides the amount of coverage they need. This could lead them to seek a new policy with higher limits or more comprehensive benefits. Another reason clients might replace a policy is to obtain lower premiums. If a policyholder's health has improved since the original policy was issued, or if they find a policy with a more competitive rate, they may be inclined to replace their existing coverage. This is especially common when clients outgrow term life policies and are seeking permanent coverage with a lower premium or better long-term benefits. Sometimes, clients may choose to replace their policies in pursuit of investment growth. Permanent life insurance policies, such as whole life or universal life, can accumulate cash value over time. However, the growth rate of this cash value can vary significantly between policies. If a policyholder is dissatisfied with the rate of return on their current policy, they might consider replacing it with a policy that has a higher potential for cash value accumulation or a different structure that better aligns with their financial goals. However, despite these reasons for replacement, it's important to recognize that replacing a policy is not always the best solution. Replacing an existing policy could come with certain risks or downsides that clients may not fully understand. For example, when a policy is replaced, any accumulated cash value in the old policy may be forfeited, which could be a significant financial loss. If the new policy has a different structure or benefits, the client might also find that it doesn't provide the same level of coverage as the original policy. Additionally, if the client is older or their health has declined, they may face higher premiums on the new policy, which could make it less affordable in the long run. This is where the role of the insurance agent becomes especially important. As an agent, you are responsible for ensuring that the replacement is in the client's best interest. You should conduct a thorough needs analysis to determine if replacing the policy is truly the best option, or if the client might be better off keeping their existing coverage. This includes reviewing their current policy's features, the premiums, the coverage amount, and the potential loss of any accumulated cash value. When it comes to the legal requirements surrounding policy replacement, there are specific rules that agents must follow. One of the key requirements is the notice of replacement. If you are involved in replacing a policy, you must provide the client with a written notice that explains the replacement and its potential consequences. This notice should detail the financial impact, such as any surrender charges, loss of cash value, or the introduction of new contestability periods. The notice must also inform the client of the potential for higher premiums or different coverage features on the new policy. In addition to the notice, the agent must also complete a replacement form. This form requires you to disclose that a replacement is being made and provides the client with an opportunity to review and acknowledge the terms of the replacement. This form is critical for ensuring that the client is fully informed about what they are agreeing to when they replace a policy. It's also important to be aware of the risks associated with unethical practices in policy replacement. The practices of churning and twisting are prohibited by law and can result in severe penalties, including the loss of your insurance license. Churning occurs when an agent convinces a client to replace a policy solely for the agent's financial benefit, often by using misrepresentation or by making false claims about the value of the new policy. Twisting is when an agent misleads a client about the benefits of a new policy, often by downplaying or hiding the drawbacks of the replacement. Both practices are considered unethical and are closely monitored by state insurance regulators. As an agent, it's essential to also be aware of state-specific regulations regarding policy replacement. Each state has its own set of rules and guidelines, and these may include specific waiting periods or restrictions on when and how replacement can occur. Some states may require that the client be provided with a comparison of the old policy and the new one, highlighting key differences in premiums, benefits, and other features. Additionally, agents must consider the contestability period when replacing policies. The contestability period is the time frame during which an insurance company can investigate and deny a claim due to misrepresentation or fraud in the application. When a new policy replaces an old one, the contestability period on the new policy typically starts from the beginning. This means that if the insured dies during the contestability period, the insurer can review the application for inaccuracies or omissions that might result in a denied claim. It's also worth noting that some clients might seek policy replacement for special coverage needs, such as those related to high-risk professions, military service, or aviation. These individuals may require specialized policies that offer higher limits of coverage or certain exclusions based on the nature of their occupation or lifestyle. When dealing with these cases, it's important to ensure that the replacement policy provides adequate coverage for the client's unique situation. In conclusion, policy replacement is a significant decision for both the insurance agent and the client. As an agent, your responsibility is to guide your clients through this process with integrity and care. By thoroughly evaluating their needs, explaining the potential consequences, and adhering to all legal and ethical requirements, you ensure that the client is making a well-informed decision that will benefit them in the long run. In the next chapter, we'll delve into special markets and niche insurance products, exploring how certain life insurance products are designed to meet the unique needs of specific groups of people, such as children, military personnel, or individuals with high-risk professions. In this chapter, we will explore some of the more specialized areas of life insurance that cater to specific markets or unique needs. While most life insurance products serve the general public, there are certain circumstances or professions where a more tailored approach is necessary. As an insurance agent, understanding these niche products is essential, especially when working with clients who might not fit the typical profile for life insurance or have unique requirements. By understanding these specialized products, you can offer better solutions for your clients and expand your expertise as a life insurance professional. One of the first areas we'll look at is juvenile life insurance. Juvenile policies are life insurance policies that are purchased for minors, typically by their parents or grandparents. These policies are often whole-life policies, which means they come with a savings component that builds cash value over time. The appeal of juvenile life insurance lies in the fact that it locks in a child's insurability at an early age, regardless of any potential health issues that may arise later in life. By starting a policy when a child is young, the premiums tend to be lower, and the policy can accumulate cash value that may be used for college expenses, a down payment on a home, or other financial needs in the future. However, juvenile life insurance isn't just about providing financial benefits later in life. It's also about offering peace of mind for the parents. If the child were to tragically pass away, the policy would provide a death benefit to help with funeral expenses and other costs associated with the loss. When selling juvenile life insurance, it's important to explain to the policyholder that the purpose of the policy is not just for financial protection, but also as a long-term asset-building tool. Next, let's move to guaranteed issue and simplified issue policies. These types of policies are often used by individuals who might not qualify for traditional life insurance due to their age or health conditions. In a guaranteed issue policy, the insurer guarantees acceptance, regardless of the applicant's health status. There are typically no medical exams or health questions involved in the application process. While this makes the policy accessible to a broader group of people, it often comes with higher premiums and lower coverage amounts. Guaranteed issue life insurance is commonly used for people who may have been denied coverage by other insurers due to serious health conditions. On the other hand, simplified issue life insurance is a policy that still requires some basic health questions, but the underwriting process is much quicker and less invasive than traditional policies. These policies typically have a faster approval process, which appeals to people who need coverage quickly. While they still have some medical questions, they don't require a full medical exam. Like guaranteed issue policies, the coverage amounts may be lower, and the premiums may be higher than standard policies. But they provide an option for individuals who might struggle to qualify for more traditional life insurance options. Another special market involves stranger-originated life insurance, STOLI, and investor-originated life insurance, IOLI. These are controversial and often illegal practices where investors purchase life insurance policies on the lives of strangers, typically elderly individuals, with the intent to profit from the death benefit when the insured person passes away. In these cases, the investor is not the family member or the person taking out the policy. and they have no insurable interest in the life of the insured. These practices have been criticized for their ethical concerns, as they can lead to financial exploitation of vulnerable individuals. Many states have specific laws and regulations prohibiting STOLI and IOLI arrangements to protect consumers from being taken advantage of. In contrast, there are other niche insurance products for high-risk professions. Certain occupations. Now that we've covered many important topics in life insurance, it's time to shift focus toward preparing for the life insurance exam itself. This chapter will provide you with key strategies and tips to help you approach the exam with confidence, manage your time effectively, and ensure you can recall the information you've studied. First, let's talk about reviewing key concepts and the commonly tested topics. The life insurance exam is designed to assess your knowledge across a broad range of subjects, and it's important to identify the areas that are most frequently tested. These topics typically include things like insurance basics, types of life insurance policies, policy provisions, underwriting, and regulations. As you prepare for the exam, make sure you spend extra time reviewing these core areas. One way to identify commonly tested topics is by reviewing study guides and practice exams, as they often highlight the areas that show up the most on the test. This doesn't mean you should ignore the other topics entirely, but it helps to focus on the most crucial ones so you can allocate your time and energy more effectively. Next, let's talk about how to decode tricky questions. Life insurance exams often feature questions that can be a bit complex or worded in ways that make them tricky to answer. One common trick is that questions may use negative phrasing, such as, "Which of the following is not?" or "Which of these is the exception?" These questions require extra attention and careful reading. The key to handling these tricky questions is to slow down and really think about what's being asked. Read the question thoroughly, and then carefully review the answer choices. If you don't immediately know the answer, try to eliminate any obviously wrong answers first. By doing this, you can increase your chances of selecting the correct answer even if you're unsure about the specifics. Another important tip is to break down the question into its key components. For example, if a question asks about life insurance policy provisions, identify the specific provision being discussed in the question. Is it asking about the grace period, the incontestability clause, or the beneficiary designation? Knowing what specific concept the question is testing will help you narrow down your options and make the right choice. Practice questions are a great tool for familiarizing yourself with how questions are structured, and they can help you get used to this type of analytical thinking. When it comes to time management during the exam, it's crucial to pace yourself. The life insurance exam is time-limited, and you want to ensure that you have enough time to answer all the questions without rushing at the end. As you go through the exam, aim to answer each question within a set amount of time, usually around 1 to 2 minutes per question, depending on its complexity. If you're stuck on a question, don't spend too much time trying to figure it out. Instead, mark it and move on, and then come back to it later if you have time. By not getting bogged down by a tough question, you'll prevent yourself from running out of time on easier ones. Taking practice exams is another essential part of your exam preparation. Practice exams help you become familiar with the format, the types of questions, and the time constraints of the actual test. After completing practice exams, review both your correct and incorrect answers. Understand why you got a question wrong and use that as an opportunity to reinforce your understanding of the material. By repeatedly testing yourself in a simulated exam environment, you'll build both knowledge and confidence, which will be incredibly helpful on exam day. One common mistake many test takers make is assuming they can cram everything in the night before the exam. While last-minute review is fine for refreshing your memory, it's essential to have a solid foundation well before the exam date. Spread your study time out over weeks or months, allowing for plenty of repetition and review. Spacing your study sessions helps improve retention and ensures that the material stays fresh in your mind. When you sit down for the exam, it's also important to remain calm and focused. Test anxiety is common, but you can manage it by breathing deeply and staying positive. Before starting the exam, take a few minutes to read through the instructions carefully. Make sure you understand how many questions are on the test, the time limit, and the scoring system. Knowing what to expect will help you feel more in control and less anxious. On the actual test day, get a good night's sleep and eat a healthy meal beforehand. Arrive at the testing center early so that you can take a few moments to relax before you start. When you begin the test, read each question carefully and think about the material you've studied. Remember that you've prepared for this moment, and with the right mindset, you can tackle the questions effectively. Lastly, let's touch on what to expect on exam day. When you arrive at the test center, you'll likely need to present identification and check in. The exam may be computer-based or paper-based, depending on your location, but either way, you will be given specific instructions on how to navigate the test. Some exams are multiple choice, while others may include true, chalk, false, or fill-in-the-blank questions. Whatever the format, be prepared for a wide range of question types. Stay calm, read each question carefully, and manage your time wisely. Once you finish the exam, you'll typically receive your results immediately or within a few days, depending on the testing center. If you pass, congratulations! You've earned your life insurance license and are ready to start helping clients secure their futures. If you don't pass, don't be discouraged. Many people don't pass on their first attempt, and you can always retake the exam after reviewing the areas that need improvement. To wrap up, preparing for the life insurance exam is a process that requires dedication, time management, and strategic studying. By focusing on key topics, practicing with sample questions, staying calm, and pacing yourself during the test, you'll be setting yourself up for success. Best of luck as you move forward in your exam preparation and toward earning your life insurance license. As we reach the conclusion of our life insurance exam masterclass, let's take a moment to reflect on everything we've covered. You've learned a lot over the course of this training, and now it's time to solidify the key concepts and strategies that will help you succeed on the exam and in your career as a licensed life insurance agent. First, we discussed the insurance basics, how insurance works, the concept of transferring risk, and the role of insurance in creating financial security. You now understand the important terminology and concepts, such as premium, policyholder, and beneficiary, along with the law of large numbers and the importance of insurable interest. We then moved into types of life insurance policies, from term life insurance to whole life, universal life, and variable life insurance. You've learned the differences between renewable, convertible, and traditional policies, and how each of these products serves different needs. We also explored specialized policies like survivorship and joint life insurance, as well as final expense and credit life insurance, which are more tailored to specific situations. In policy provisions, options, and riders, you learned about the mandatory and optional provisions in a policy, such as the free look period, grace period, and the incontestability clause. You also discovered the benefits of policy riders, like waiver of premium and accelerated benefits, that offer additional flexibility and coverage in specific circumstances. We then explored insurance contract law, helping you understand what makes an insurance contract legally binding. You learned about important contract elements like offer, acceptance, and consideration, and you now know the difference between unilateral and bilateral contracts, as well as the significance of representations and warranties. We also discussed fraud, misrepresentation, and concealment, and how these factors can affect the validity of a policy. Underwriting and risk classification came next, where you gained insight into the underwriting process and how insurance companies assess risk. You learned about medical and non-medical underwriting, risk classifications, and how factors like health, lifestyle, and occupation impact premiums. You now understand the role of the Medical Information Bureau, MIB, and how consumer reports can influence underwriting decisions. When we covered life insurance premiums and costs, you learned about the different factors that influence premium rates, including age, gender, and health. You're now familiar with the different premium structures, such as level, graded, and flexible premiums, and you understand the concept of mortality tables and how they factor into determining premium costs. The chapter on annuities and retirement planning introduced you to the different types of annuities, fixed, variable, and indexed, and how they can be used as part of a retirement strategy. You now understand the difference between immediate and deferred annuities, the accumulation and payout phases, and the tax implications of annuities. In federal and state regulations, we reviewed the role of state insurance departments and the NEC in setting standards. You've also learned about licensing requirements, producer responsibilities, and important consumer protection laws, such as the GLBA and HIPAA, that protect individuals' privacy and personal data. We then moved on to taxation of life insurance and annuities, where you learned how life insurance proceeds are generally tax-free, but the growth in cash value can have tax implications. We also explored the taxation of annuities and discussed the rules surrounding modified endowment contracts, MECs, and the 1035 exchange for policy replacements. Group life insurance and business uses gave you an understanding of employer-sponsored life insurance plans, including contributory and non-contributory plans. You learned about key person insurance and buy-sell agreements, and how life insurance can play a role in business continuation planning. Additionally, we discussed tax advantages and employer contributions. The chapter on Social Security and government programs provided an overview of Social Security survivor benefits, disability income protection, and Medicare and Medicaid. You now understand the basic concepts behind these programs and how they fit into the overall financial safety net. In ethics and best practices for agents, you learned the importance of acting with integrity, adhering to fiduciary responsibilities, and following industry regulations. You also gained insight into fair practices, suitability in selling insurance products, and the importance of continuing education for professional development. Policy replacement and special considerations explain the rules surrounding replacing policies, highlighting the risks involved, such as the loss of benefits or higher premiums. You learned about the agent's role in ensuring clients make informed decisions and the importance of understanding state-specific regulations. Finally, we discussed special markets and niche insurance products, such as juvenile life insurance, guaranteed issue policies, and the unique needs of high-risk professions. We also covered important considerations for military and aviation personnel and the controversial topic of stranger-originated life insurance, STOLI. As you prepare for the exam itself, remember that the test will cover a wide range of topics, but by focusing on the core concepts we've discussed, you can approach the exam with confidence. Take practice exams to familiarize yourself with the question format and refine your test-taking strategies. Review your weakest areas and focus on those in the final days before the exam. Now, as you get ready to take the life insurance exam, here are a few last-minute study tips. Focus on your weakest areas and make sure you understand key definitions, principles, and processes. Don't try to cram too much information in one sitting. Review the main points and test yourself. Get a good night's sleep before the exam and stay positive and calm. You've prepared well, and you have the knowledge you need to succeed. Once you pass the exam, you'll be well on your way to starting your career as a licensed life insurance agent. But your learning doesn't stop there. The insurance industry is always evolving, so continuing education and staying up to date with regulations and new products will be key to your long-term success. Passing the life insurance exam is just the beginning. With the knowledge you've gained in this course, you're well equipped to enter the industry with confidence. The key to success in this field is dedication to serving your clients, continuous learning, and applying the knowledge you've gained to help people protect their futures. Good luck, and remember, every step you take in your career helps create financial security and peace of mind for those who need it most. If you found this course helpful, make sure to like, follow, and subscribe to my insurance guide for more insurance topics. We're committed to bringing you the latest tips, strategies, and industry insights to help you succeed in your insurance career. Don't forget to hit the notification bell so you never miss an update, and feel free to leave any questions or comments below. Thanks for watching, and good luck on your exam.